Well, good afternoon. As I have 12 o'clock, I think we'll get started here because we value everyone's time here and appreciate you making the time to listen to us today. So today we're going to talk about the integration of PPP and ERC. You can tell the program's been along for quite a while when I can just use letters and expect most people will know. But the Paycheck Protection Program and the employee retention credits have really evolved since they first came on the scene. So we're going to talk about the Paycheck Protection Program, just where we're at, what to expect and how to move forward. Talk about the employee retention credits. And that'll be those two parts will be the majority of our program. We'll talk then about how the impact of PPP choices impact the employee retention credits and vice versa. So, and what you should do in which order. We're going to talk about may not have heard that acronym, the ARPA credits or the COVID credits that are back. There's another option on that, and those all and how they also impact your payroll taxes. Then we'll talk a little bit about the credit services that are out there that some of you may have been contacted by, and some of you may have been may have chosen to use or may be considering. So PPP loans, that since they really came on the scene, really last April is when a year ago April is when they first came about. Lots changed. Well, one thing that is easy to understand and we can all say is right now there's no more loan applications being accepted. Whether it's PPP1, PPP2, it doesn't make any difference. All the loan applications have been accepted. There's a couple loans that they're trying to get through the system that if your loan was already in the system, but they're trying to clear some of the tags or markers on it to get it to go through. There may be a couple there, but other than that, actually getting the dollars is done. There's right now, from what we're reading, there's no general PPP expansion really being contemplated. And this is even though the sole proprietor rules dramatically changed after the PPP2 program started. Those that delayed applications got dramatically more money than those that needed the money early and applied early. There's talks of some targeted programs. Ones you're hearing most commonly are for hotels and health clubs. But right now it's just talk. They're talking about floating ideas, but nothing's really out there. So as far as getting additional dollars, it's right now there isn't that opportunity. So it's really now all about forgiveness. So in 2020, you had a choice of 8 weeks or 24 weeks for forgiveness. In 2021, now we have the period of any period from 8 to 24 weeks. Those of you that have listened to this whole series of webinars that we've had on this program as it has evolved, know that we were telling people, even though the SBA says you can apply anytime after you spent the funds, we were suggesting to people that no, you really have 8 or 24 because of the certifications. That's no longer the case. So if you have in your PPP2 program, if you've used the money up after 11 weeks, you can file your application covering 11 weeks. And you can make your certifications, and it only goes through for the 11-week period. So that's a change from what you have heard in the past, because this program has been evolving the whole time as we've gone along. So it doesn't really mean what we told you was the best that we had in at the time, and that government has continually evolved the program. which is understandable because the idea was get the money to people as fast as we can, and we'll worry about the details later. That's a good summary of the program. But when we're looking at payroll, remember the purpose of the program was to keep small businesses alive, and it evolved to make sure that most of the money was used on payroll. Now, remember, payroll is what you think it is, but there's other things included in PPP payroll. PPP payroll, well, what we did here is we put together what you have to incorporate for forgiveness. That gives you good examples of really what you need to do for forgiveness. This is where it's all about. So you need to show that the cash was actually paid to employees. So it either, if you have an outside service, they'll accept an outside service. And if you are writing checks yourself, they want to see that the checks have actually cleared bank statements. So in other words, what you would think of as payroll is payroll. You cut payroll checks. It's the gross, think of it as the gross payroll. You also have to show tax forms or reports from an outside service provider that are through the covered period. The reason you have to show the tax forms is, one, it helps document the payroll paid. But remember, you also get to include state unemployment taxes as payroll. Remember, not federal. That's why you don't have to worry about a 940 form, because it doesn't add any payroll. But the state unemployment does count. Then you're looking for documenting the health insurance that you paid, any retirement plans that you may have funded. Also, for those of you that have union benefits for your employees, those union benefits will count towards health as payroll costs. So it's the payroll you'd expect plus some other additional things that are considered payroll for PPP purposes. So the most common ones are health insurance and retirement plan benefits, union benefits, and state unemployment taxes. Now, if you're going to take the employee retention credit, you can't include wages that you're going to consider for the credit. Now this you didn't see if you applied for your forgiveness for the first round for PPP 1, before the end of December of 2020, you never saw this. Why didn't you see it? Because you were prohibited from claiming an ERC credit, employee retention credit. You're prohibited from doing so if you got a PPP loan. Well, they changed the rules retroactively, saying you can do both. So we have to look at what you really should do with that. We'll talk a little more about that later. Now, when you're looking at PPP forgiveness, you have to have at least 60%. You can have more, but at least 60% of your forgiveness must be payroll costs. The other 40% or less may be non-payroll costs. So there were some ones that you would typically think of that would have been there the whole time: mortgage interest, business rent and lease payments, and business utility payments. Now remember the nuance for business rent, that if you are renting to yourself, then we have to look at just the interest on your building counts as rent, it does not include the actual lease payments, regardless of when your lease started. It's probably my biggest pet peeve change, but we have to deal with the rules that are there. Now, what happened is they allowed some other expenditures to fill that 40%. So what we're going to look at are, these are supply costs, PPE, worker, for your PPE expenses are really important. So they're allowing you to include that to backfill that 40%. If you have property damages and for certain operating expenditures. So for most of us, think about it, that's nice that they added more things, but because the loan is for 2.5 months of payroll, and we have approximately 5.5 months to expend it, the issue is not really adding more non-payroll costs. It really, for most businesses, they have no trouble covering it with payroll itself. But these non-payroll costs will become more important when you're looking at the integration of PPP and ERC. And I'll continue to use the acronyms because they tend to go pretty long. So what you want to look at is, in the past, we didn't care about this. At least I didn't when I was helping people during 2020. I didn't care about these other expenditures because it was all about payroll. Well, now since you can have both the credits and the payroll, these are more important. I'm not going to go down everything that covers that's in there. We've covered that in other seminars, but just take a look through that. If you need some other non-payroll cost to backfill, that may be important for many people. The reason they're going to need some more of these back costs to backfill are the people that have limited rent because they own their own building. So with forgiveness, I think many the common questions we're having, there seems to be a tug of war on when you have to apply for forgiveness. Now remember, the bank is making the glorious amount of a 1% interest rate on these loans. Grant, don't cry for your bank because they were paid well to process the applications. They're paid very well to process the applications. But the actual money they make on the loan is quite small. So the bank may be telling you, you got to apply for forgiveness now. And they may want you to, so they can get that loan paid off and then deploy those funds elsewhere, right? But it's really not the bank's choice on when you apply for forgiveness. It's not the bank's choice. So when you want to make sure you apply for forgiveness after all the loan proceeds have been used for qualifying expenditures. You have any time until 10 months after the last day of the covered period to apply for forgiveness. That's really when we're talking to people, because if you apply within 10 months after the last day of the covered period, what happens is your payment should still be deferred, right? Because right now you're not making any payments on the program because you're expecting for forgiveness. So So you want to make sure you've applied for forgiveness within that 10-month period, because that way you should not have to make any payments on the loan. If your lender requires payments on the loan, when the forgiveness happens, you will get that money back. Okay, you will get the money back, but it's better not to have to pay for it up front. If there's an issue at the 10-month period, remember, you can apply for forgiveness anytime until the maturity of the loan. For most people, for PPP 1, it means within 2 years. Within 2 years. This 10-month period is, for many people, is coming up here soon. Because if you got your funds in April of 2020, way back then, April of 2020 for the first round, you can use the 24 weeks of the covered period. Then you get 10 months after the end of the covered period. So that means even if you are the early round of people for getting your dollars, your forgiveness application must be in by July sometime, and the exact date depends upon the exact date that you got your funding, but April will get you out to July. That way you won't have to make payments. So if you haven't applied for PPP 1 forgiveness, you're going to want to do so soon. Exact date kind of depends for you. But don't make your lender cannot tell you you have to apply now. Now we have some lenders on the other side that they are saying they want you to delay your application for forgiveness. Well, the reason they want to, it's not written, but as you may recall, if you're there's different forgiveness applications that have evolved over time. There's the regular one, there's a simple, and there's an easy. So what we really wanted, if the easiest forgiveness is if your loan is $150,000 or less. It's relatively a simple process. It's mostly just certifications. Life is good. The most complex is if your loan is over $2 million. And if your loan is over $2 million, and especially if you had, and those of you that may have some changes in your employment, fewer employees now, that was in the applicable period, you'll have to fill out the longer form. Well, what the government's looking at talking about doing, the SBA is talking about doing, is that they want a easier application for those people between 150,000 and 2 million. So that may be why your banker may want you to wait. We'll see how long it takes things to go for them to get things done. There are some things moving forward in forgiveness. We had a number of our clients with loans over $2 million get forgiven in about the same 48-hour period. It was kind of remarkable that they all happened about the same time, even though their applications did not go anywhere near the same time. The applications were as much as 6 months apart, but the forgiveness date was for all of them was within 48 hours. So there is some movement in that. That's a really good thing. Now, if we look at the Employee Retention Credits, or ERC program, it's changed a lot. Now, remember, it was initially, there was a lot of restrictions, so we didn't talk about it. Now, it is it can be quite impactful. So remember the PPP program, the loan comes in, you document, you spent the money. The SBA then repays the bank. you get forgiveness. On the forgiveness, there's no federal income taxation. Most states don't tax you on it. Minnesota, we're hoping won't, at least that's the proposals that are going through the legislature right now, wouldn't have any taxation on it. Pretty, then you're done. Now the employee retention credits are different. They're following more the jobs credits methodology. So those that may remember the jobs credits, they're still around, but they're not used as much. And the jobs credit are if you hired certain people, what happened is the government gave you a credit for hiring those people. And then what you do on your income tax return, you showed a reduction in expense for the credit received. And then you received an income tax credit. It's similar, but not identical to that process. What's happening is you claim this credit on your payroll tax return rather than your income tax return. Why the change? Well, the change is because they want to make sure that these credits can be used by nonprofit organizations. So if you have a non-tax paying entity, you still can get these credits because they're coming through as a payroll tax credit. Then but the payroll tax credit you're receiving, that credit you're receiving on your payroll tax return, you use as a reduction in your wage expense on your income tax return. And life continues forward. So you've got a payroll tax impact, that's where you get the refund. You've got an income tax refund, that's where you show the impact of the credit on your taxable income. So for 2020, we can now claim these credits, and you're saying, oh my goodness, how does this work again? So you're going to qualify if you or your business was suspended by government order. So remember that a suspended by government order doesn't mean you had to be totally shut down. If they restricted your hours, that also qualifies as a suspension. And it's or, so that in and of itself allows you to have ERC credits. Or if you could show that you had at least a 50% decline in gross receipts when you compare a calendar quarter in 2020 to the same quarter in 2019, you can receive a credit. If you have 100 or fewer full-time equivalents, FTEs, full-time equivalents, and you paid qualifying people who are not providing services. So if you had, let's set it backwards, sorry. If you have more than 100 FTEs and you pay people who are not working, you can get a credit for paying those people, even who are not working. If you have 100 or fewer FTEs, you get a credit for everybody you paid, whether they were working or not. That is a huge difference. So whether they're working or not, you can get a credit. And if you qualify in one quarter for that reduction, you will qualify for the next quarter and maybe future quarters in 2020. Remember I said if your business was suspended by government order. Now, many businesses were required to work remotely. That is not a shutdown or suspension. If you were required to work remotely, your business is still allowed to operate, maybe not in the manner you wanted, and maybe that manner didn't work for you. but they're not calling that a suspension by government order. And if you sell to a business that was shut down or suspended, you are not shut down. So even though you can't sell to them because they may not be open, you yourself are not shut down. You do not qualify for that particular exception. When you're looking at what wages qualify, if you're looking at the suspension cause, it is the wages paid during the suspended period. So if you were shut down or suspended from March 20th to April 20th, 2020, you will have qualifying quarters in quarter 1 and quarter 2 for 2020. But the only wages that qualify are from March 20th to March 31st in the first quarter, and April 1st to April 20th in the second quarter. But those wages will qualify. What we're seeing the biggest impact is on the gross receipts test. And if you think of it logically, if you are suspended, your gross receipts are most likely going to decline. If you're selling to a business that was suspended, maybe you don't qualify for being suspended, but your revenues will very likely decline. And this way, you're looking at the quarter, not just the period of time you're suspended. So this is where you should focus your time and energies. So if you have a quarter where the gross receipts are less than 50% of the same quarter in 2019, you have a qualifying quarter. You'll have qualifying quarters until the receipts have returned to at least 80% of what they were for 2019. And all the wages paid during the qualifying quarter will qualify for the credit. And remember, you got the difference of the large versus small companies. So whether or not you're going to be able to pull, yeah, there'll be qualifying wages, but is it a qualifying person? So it could be quite a deal. Now, remember, this is just math. This is just math. So when you're looking at gross receipts, it's really important what gross receipts do you look at. And wouldn't it be really awesome if there was a list of exactly how you determine gross receipts? It would be awesome. There are a lot of examples in there, but there's nothing that says that tiers that, okay, here's how you define gross receipts. Is it first tier 1? Okay, if you're replying, whatever you report to the bank, the accounting method you use to report to the bank, if you're giving reports to a bank, or things that you use in your internal accounting system, or and then maybe you drop down to, for those of you that may not only gather income once a year, be how you maybe just apply for your income tax return, kind of putting priority levels. Wouldn't it be nice if they did that? They don't, and they're not going to. At least that's from what I've heard. There's no, they know it's an issue, but no one wants to address it. Well, when you think of how you're doing your gross receipts, the way we think of it is just really how you do your internal accounting. And it's important, how you do your internal accounting can really vary. And it can really impact how you do things. So think about it. If you do your internal accounting on accrual basis, then logic would say you should use your accrual basis records. If you, as you go along, say you keep track of your accounting on a completed contract method as you go along, and it's only at the end of the year that maybe we help you adjust to percentage completion. Well, if you think about how you do your accounting for comparison purposes, it would really be completed contract accounting for the first 3 quarters. So you're going to compare that. Well, think about what completed contract accounting does. It tends to bunch up receipts in 1 quarter or not. Or, and those bunching, unintended bunchings, I think it behoove you to actually look at what your gross receipts are. We've had people that qualify for this bunching reason. We've had people that qualify not because maybe 2020 really didn't even decline that much. You're fortunate. Well, but maybe you had an awesome 2019. That awesome 2019 you're comparing back to may qualify you for quarters, because you don't look at what revenue is for the year. You don't look at whether or not you lost money. There is no needs test. There is no requirement that you feel uncertain. It is just math. So take a look at the math, and it may change how you're going to do some things. So if you look at what we do at JAK, we follow what we tell our clients to do. We actually report our monthly amounts on an accrual basis, because like we tell our clients, it's much better to analyze your business based upon how things are going than how cash flow is coming, whether or not you pay something or whether or not some money was accelerated or not for receipts. That shouldn't impact your business decisions. You should look at an accrual, where you do the same thing here. But what if we actually kept track of our accounting on a cash basis? Because that's how we file our tax returns. We file our tax returns cash. But what if we did our accounting on cash? Well, cash varies and changes. And that vary and change and that bunching can really impact whether or not that gross receipts method could qualify you, even though your income didn't drop. So take a look. So let's look at some of the math. So remember, when you're looking at gross receipts, I have to show a 50% reduction. I qualify until I get to at least 80, and life is good. Okay, so 2020 rules. In quarter 1, we're going to say that the gross receipts dropped to 40%. 40%. Well, if they drop to 40%, that's less than 50. Quarter 2, that I'm at 58%. Quarter 3, 85. Quarter 4, 77. So my if I just take those as given numbers, so I'm at 40. I'm going to qualify for quarter 2. Why? Because I haven't. I qualify on the gateway in quarter 1. Quarter 2 in and of itself, it's not less than 50, but I don't have to get to a 50% test for quarter 2. Quarter 1, I get to continue until I get above 80. So that means quarter 2 applies. Quarter 3, I'm above 80. Well, because I still was qualifying in quarter 2, I get to go through the quarter until I get above 80. So that means quarter 3 applies. I get to quarter 4, I'm at 77%. If I'm at 77, I no longer qualify. Why do I no longer qualify? Because I have to, now that I got above 80, I got to start all over and get below 50. So I got to get below 50. So since I'm not below 50 in quarter 4, Therefore, quarter four will not qualify. So you gotta look at, so you're just gonna look at where they have an eligible quarter. You have to look at FTEs, and you want to see how life moves forward. Now, allocable wages. You can have no more than $10,000 for the year for any employee. Your credit rate is 50%, so it's a $5,000 credit. So it's $10,000 for the year for an employee, and it is a $5,000 credit maximum. Wages do include healthcare costs. If you are just paid healthcare, you can still take the credit based upon the healthcare. That was a clarification, because when people are on furlough, what happened, I may not be paying the person, but I can still qualify that, but I may still be paying their healthcare costs. That can qualify for these credits. Now, what's different here, a very key difference between PPP and ERC is self-employed and partner payments don't count. They're not wages for this purpose. You look back at 941s, and if you think about it, you're taking the credit on 941s. So they want to make sure that there's 941 wages. And you say, well, Todd, sentence above said, hey, if I paid healthcare, I'm not going to have anybody on a 941 in that case, and that is correct. But I'm just saying that's the logic I think of it. It's the way I try to explain it to people, is it can only qualify for somebody who would have been reported on a 941. Now, remember that these rules are tied to the jobs credit rules. And they don't want people just hiring their relatives and receiving employment tax credits. And they want you hiring people, but not just for the purpose of getting credits. So if you have certain relationships and someone owns 50% or more of the capital or profits interest in the business, those certain relatives are not eligible for this credit. So you cannot hire a child or a grandchild, a brother, sister, stepbrother, stepsister, father, mother, grandfather, grandmother, stepfather, stepmother, or a son or daughter of brothers or sisters. No, there's no nieces or nephews, no aunts or uncles, and no in-laws. Pretty expansive list. And if you just think of it, we don't want you to just hire people to get credits. That's where they're coming from. Pardon me. But a common question we're getting is, can you claim a credit for wages paid to the owner? Well, if you look there, what do you see the actual owner listed there? I don't see the owner listed there, and I don't see the spouse of the owner listed there. A lot of other people, very expansive definitions, but not the owner and not the owner's spouse. So there's debate on whether or not that payments to the owner and the owner's spouse qualify. Why is there even a debate? It's pretty darn clear list, right? Well, debate comes into tax nuances. So One, the IRS is allowed to make rules similar to those jobs credit listing. Okay, they're not required to use those. They're required to use rules similar. So it would be possible the IRS would develop a different set of rules where the owner would be a prohibited person. And then if you really get into tax details, or if you're like me and you're a tax nerd and you're proud of it, what happens is if I'm in a business and I hire my brother, okay? My brother's name is Mark. So Mark and I are in business together, fine. And if I own it, Mark's my brother, I can't take a credit. But then Mark is deemed to own the shares that I own. Well, now Mark, as a deemed owner, his shares would be, I am now his brother. Versus the owner, I am the brother of my brother, and he's a deemed owner of my shares. And if someone puts all that together, it could be used as a reason not to give credits to the owner or the owner's spouse. Well, the IRS knows that it's an issue. And we really would like some clarification, right? So what has happened, even though that everybody knows we want clarification? Not a blessed thing. And since we're living in the real world, we can't really wait until everything is out there. So right now, for our clients, we'll be talking them through it, but we're going to be letting them know that we'll prepare credits as if the owners do qualify. And if the rules change, we can amend payroll tax returns later. I apologize for the noise. If you're hearing noise, it's really nice that the lawn mowing guys decided to come by today. So I apologize for the noise in the background. But you can make your own decisions. I'm just telling you that's the decision that we're going to make here. So take a look at, so if we have a large employer, if you move to takeout only, you had restrictions. If you have more than 100 FTEs, then you only get credits for those people who do not perform services. So if you paid people not to perform, thank goodness. That was a good use of the program. You can take credits. That credit is up to $10,000 of wages for any employee, which would lead to a maximum credit of $5,000 per employee. Same facts, but if you had 100 or fewer, now everybody that you paid during that suspension period, whether they worked or didn't, qualified for the qualifies for the credit. Same limitations apply, meaning $10,000 per employee, which is a $5,000 maximum credit, but everybody qualifies. So if you look at the retention credit here, if I have Abby, Bob, and Chris, and here's their wages in each of the first 3 quarters. And that's what they're paid during the suspension periods. So because they were restricted, yes, they were doing takeout, but their hours were restricted. So therefore, they're eligible quarters. We work everything through. So in quarter 1, we're saying that, remember, they didn't move until quarter 2. So in quarter 2 and quarter 3 will be my periods. Abby was paid $7,000. So that means Abby's wage for quarter 2 is 7. Bob was paid 10. Chris was paid 15. Now, notice that even though, if you go back to my example here, if you look, that both Bob and Chris were paid more than $10,000 in quarter 1, 10,000 or more. So You don't have to count the wages you didn't use for the retention credit. You don't have to count those. So it's just wages used during the credit period. That was the purpose of that part of the example. So I have a $10,000 amount for Bob. That's what he was paid. $10,000 cap on Chris because he was paid 15. $27,000 total wages, 50% credit, 13 credit rate, $13,500 credit. Quarter 3, Abby was paid $5,000, but I only use 3 because the amount that caps out the maximum amount of the credit to $10,000 of wages. I already capped out Bob and Chris. $3,000 eligible wages, 50% credit rate, $1,500 credit. If you add those together, $13,500 and $1,500, $15,000 credit. 3 people maxed out a $5,000 credit. The math works. Well, the government just decided to really amp up this employee retention credit. It's amazing the dollars that are involved. Remember, it was $5,000 for the year was the maximum credit in 2020. $5,000 for the year. Now that $10,000 in wages, they kept that $10,000, but instead of it being an annual amount, it is a quarterly amount. In October, in December, they said it's for wages paid no longer than June 30th, 2021. Then in March, they changed this, the June 30th to December 31st. So now it's for all of 2021. The credit rate is 70%. So I can now get what I used to have an annual limitation as a quarterly limitation. And now I can have the credit rate went up. So I have a higher credit per employee, and I can use it for 4 quarters, not just once a year. And rather than looking at a 50% or more decline in gross receipts, it's a 20% or more decline in gross receipts. And rather than just if being 100 or more than 100 full-time equivalents, to look at only taking the credit for people who are paid, now it's 500 full-time equivalents. So they've substantially increased the number of businesses that can qualify. They substantially lowered the barriers to receiving the credit, and they really juiced up the amount of credit. So if you think about it, you're going to get a $7,000 credit per employee per quarter for 4 quarters. That's a $28,000 quarter per quarter credit, per year credit. That's versus $5,000. So you got the same restrictions. It's either you're suspended or you have the gross receipts. Qualified wages has been changed to December 31st. But for those that had 500 or fewer employees, was 100. Now we get everybody, large employers now over 500 rather than just there. Look at the decline in gross receipts. It makes a big difference. And now that bunching thing I was talking about, it's more likely you can qualify. That bunching is more of a 2021 issue. So when you're looking at gross receipts, you want to look at sales, net of returns and allowances, amounts received for services, and then any investment income. The PPP forgiveness itself is not considered gross receipts. That's clear. PPP forgiveness is not gross receipts. So the period for the credit is all of calendar year 2021. So now if we look at the same, and I'm just saying quarters 1, 2, and 3 again, but we're now looking at 2021. So now if I got the same 3 people, Abby, Bob, and Chris. And now I look at, let's say that they only qualify for quarters 1 and 2, and they're not going to qualify for quarter 3. Now, all the wages that paid to Abby qualify because she was paid $10,000 or less for the quarters. Bob was paid 10, his 10s qualify. Chris was paid 20 and 15, so he gets 10 and 10. So if you add it together, there's $26,000 of wages in quarter 1, $27,000 of wages in quarter 2, 70% credit rate, which gets to $18,200 credit in quarter 1, $18,900 credit in quarter 2. So that means instead of, in 2019 for 2 quarters, I had a credit of $15,000. 2020, when I'm looking 2021, I have a credit of $37,100. The credit went up 2.5 times, almost 2.5 times. There's also a safe harbor you can look at that you can look at the quarter before your calendar quarter. If you look at the quarter before, that can determine whether or not you will qualify for the upcoming quarter. That's just so you know how to handle your payroll tax deposits. So if you look at the quarter before, you look at quarter 4 2020 and quarter 4 2019, that will determine if quarter 1 2021 qualifies, if you're at 80% or less. Or if 2021 quarter 1 compared to 2019 quarter 1, yes, it's 19, not 20, not 20. If you want to compare it to the last quote unquote normal year. If either one of those work, then quarter 1 works. So if you look at, now if you look at 2021, even though at in my example here, I'm at 85, quarter 1, I'm at 85% of 2019. I still qualify because under the safe harbor, I can look back to quarter 4. And at quarter 4, I'm at 77%. Quarter 4 of 2020 compared to quarter 4 2019 is 77%. So that means quarter 1 will qualify under the safe harbor. Quarter 2 qualifies under its own because it's less than 80%. Quarter 3 qualifies because I get to continue until I'm above 80%. Well, quarter 3, I will qualify because now I'm above. That means quarter 4 has to stand on its own. And quarter 4, I'm saying that the 2021 gross receipts were the same 115 as they were in 120. I'm at 77%. So in this example, all 4 quarters qualify. Even though on the face of it, you look, 2 of the quarters are above 80%. Now, interplay with PPP. Remember, they changed the loan application. Because you can get the forgiveness application, you can receive a credit even though you got PPP loan, but you can't use the same wages for the PPP forgiveness and the retention credit. So if you're deciding what's better, is it better to get forgiveness or a credit? You want the forgiveness because you get 100% forgiveness versus a 50 or 70% credit. And the forgiveness is not taxable, where the credit will actually increase your tax because it reduces deductions. You want to use hindsight to your advantage where you can. So what you want to do is look to see where you want the dollars to be. That's where I have to go back and figure out what's going on. but probably the biggest problem area that people have said, what do you do if you've already applied for PPP forgiveness? And for many people, all they did was put down payroll. Why? Because you just needed, the payroll itself gave you plenty of forgiveness. So let's make it, you were able to supply so much less documentation if all you used was payroll. And on your payroll, you didn't worry about profit sharing, you didn't worry about unemployment, you didn't worry, many people didn't worry about the health insurance. Why? Because they would have had to supply all the documentation for those expenditures. Remember when we looked at the forgiveness app, you had to put in, not only say you had the dollars, you had to show the support that you expended the dollars. Well, if can you go back and change your forgiveness application? The answer to that right now is an unfortunate no. The logic is you're only allowed to submit one forgiveness application. And if once it's made all the way to the SBA, it's darn near impossible to change it. While you're dealing with your banker, that you can pull back and change. But once it's got the SBA, it isn't, because you have, think of it as a bank document, and the bank will not let you submit a bank loan and then change it after you've already got the loan. And that's how they're looking at this, is a change to a bank loan after you've already got the loan. But if you're saying, well, Todd, what about if I put the, I just said payroll. If you read that face, it just says payroll. Well, payroll can include all kinds of these other things. It can include profit sharing. It can include health insurance. It can include unemployment. It can include union benefits. So I'll just say I use that stuff instead, and then I have my wages eligible for the employee retention credits, right? The answer to that is unfortunately wrong. Why? Because you had to submit documentation with your forgiveness application that showed what component you were using. And if all you use is payroll, you only use payroll. Now, the question is, what if your forgiveness application has more payroll on it than was needed for full forgiveness? In that case, we're saying, well, okay, if that's your full forgiveness, you only used enough of the payroll to get to forgiveness. The excess amount really wasn't used for forgiveness. So we are taking that position. Again, it's not as clear as anyone would really like, but that's where life is. Now, before you get all worried, remember the maximum amount of wages is $10,000 per employee for the year. So you have wages outside the forgiveness period. You're going to have wages where people might be paid more than the maximum amount. There's a lot of wages that are still there, even if all you listed was payroll for 2020. So yes, it's an issue, but probably not as big an issue as you think. And I think that's an important takeaway for today, is it might be an issue, but not as big an issue as you think. So now you say, well, I'm looking at how to complete things together. So when we put things together, what we're doing is, and I'm probably going to run a little over here, I apologize. You're going to, for employee retention credits, you're going to use the wages outside the PPP period. You're going to use the wages in excess of the annualized $100,000. You're going to use wages that you didn't need for PPP forgiveness. So that you're going to use, that's the starting point for ERC wages. Then for PPP, you're going to pull in the sole proprietor and partner deemed compensation, because that cannot be used for ERC. You're going to use wages for prohibited relationships for ERC. Then you're going to look at non-wage expenditures. You're going to bring in enough wage costs to get to that 60% of the relative ratio of total expenditures, wage and non-wage, and wage compared to wage, to see where that gets you. If that gets you where you need to, then you're done. Otherwise, you're going to add additional wages to get to PPP forgiveness. When you're doing that, then you're going to look back at people who made more than $10,000, because you're going to leave up $10,000 a person, and then you're going to layer. So it's a layering process. So I'd love to give you a simple worksheet to do this. It doesn't exist. It's quite complicated. But as you start walking through and just working through the layers, just like an onion, just work through the layers one at a time. It makes sense. The way we're dealing with it here, we have a couple people that are working with it more, so they understand the layers to the onion. Just want to point out that we do have, there is the COVID credits that exist that don't there's no gross receipts change for this. That's the key thing. There's no gross receipts change for this. Same type deal where this applied for on your payroll tax credits. It's very similar to the Family First credits that were out there in 2020. Here's something I want you to think about. You know, we're getting, a lot of our clients are being approached by these credit maximization services. There are rates that charge a fee based upon the credits, and it sounds reasonable, doesn't it? 10 to 15% of the credits calculated. And the credits can be quite large. Go up to $33,000 an employee, which would be $5,000 for 2020, plus $7,000 a quarter for 4 quarters for 2021. Add that together, it's $33,000. Yeah, I just want to put it out there that those percentage fees sound reasonable, but boy, are they high, and they're far above what someone would charge based upon efforts. When we've helped some people, our fee has been like 2 to 4%. So, and to put real world numbers to it, I calculated if at JAK we qualified, we have 32 people. Basically, everyone here makes at least $10,000 a quarter, so we have $7,000 in credits. And per person, so we have $7,000 in credits for 32 people for 4 quarters is $896,000. If I had a 10% credit, that's an $89,600 fee for those credits, or $134,400 at 15%. Now, if you look at what your provider happens or what we charge, I wouldn't, there's no way in God's earth I'd have $80,000 to calculate a credit for 32 people for a year. There's no way. So before you sign up with those credit services, please talk to us, talk to whoever your provider is. It's really important because it's not going to be anywhere near those rates. I'm not saying that they're wrong. Maybe the wrong person is us. Maybe we're not charging enough. But we always try to treat our clients fairly. And we charge what we believe is a fair fee, not what we can get away with. So please consider that and work forward. With that, I see I'm 5 minutes over, so I will let you get on with your day. Thank you very much for your patience. And you can always reach out and get a hold of myself or your favorite JAK contact. We'll be glad to help you. And with that, have a wonderful day. We'll talk to you soon.